Starting. All attendees are in listen-only mode.
Good morning, good afternoon, good evening. Broadcasting here from New York City. Welcome to the FX Business and Technology Trends in Asia webinar. First, I'd like to thank Steve and Edge from Asia E-Trading for helping Equinix organize this event. And we're going to jump right into making some introductions. First, I'd like to introduce Masayuki Nakajima-san. He is the Chief Operating Officer and Chief Risk Officer from FXCM Japan Securities Co. Second, I'd like to go ahead and introduce Jonathan Woodward. He is Head of Asia Pacific for FXAll. And lastly, Javier Paz is the Senior Analyst for the Wealth Management Division of Aite Group. And Javier will end up taking us into some research that he has done, sharing us a presentation up front for the first 15 minutes of this webinar. Thank you. Javier?
Thank you, Barry. So it is my pleasure to be with you today and to go over some of the research that we have done recently at Aite, dealing with the global FX market. This is, again, as a preview of what we will be discussing in the panel and to get things going a little bit. So the first slide that I'm displaying right now has to do with the long-term growth of the FX markets in general, growing from just about 2 trillion 10 years ago to more than double that amount as of 2012. We saw a bit of a slowdown in 2012 and some consolidation as a result, but 2013 is off to the races. It's although not displayed here in these charts, it is becoming a very, very good year for the industry at large. And some of the factors contributing to the growth have to do with the growth of high-frequency trading, prime broker relationships, and by prime broker relationships, we mean the participants that come to the FX market as a result of prime broker firms like Citi Prime Brokerage or Deutsche Bank Prime Brokerage and so forth. And these clients are retail FX brokers, aggregators, as well as hedge funds and high-frequency firms. So all of these players plus are enhancing the existing presence of regional banks or corporations, governments looking to participate in the FX markets. So in general, we're seeing the main two legs of FX activity have traditionally been FX swaps as well as the spot FX part of the market. The spot FX, it's certainly taken off again on the back of these high-frequency prime broker relationships, and whereas the FX swaps activity is a little bit more subdued. Certainly since 2009, where we've seen more regulations come into place, starting in 2010 in the U.S., Dodd-Frank Act, as well as regulations starting to come out of Europe and some out of Asia as well. So all of these things are portending are impacting the outlook for the industry. So we see a corresponding increase in the number of trades, and again, much of this activity is led by the firms that trade more actively, and that again, despite you would not see a slowdown really in these figures. It's pretty much a geometric growth that we're seeing in terms of number of trades. And obviously, as this trade takes place, the infrastructure has to keep up to be able to support this kind of activity. Now, keep in mind that this at 1.5 million trades per day, as measured by SCLS, it's not that big of a number compared to to equities, which does that and more, in much of a smaller time frequency. So I decided to put together a quick summary of some of the volume levels that we're seeing in Asia as of the results that were released just yesterday from the semi-annual central bank survey. And what we see here is that London is just scary high, certainly a very big number, $3 trillion in overall FX activity just by itself. Compare that to the U.S., which is this next big follower, at a third the size. And clearly, the majority of activity in the UK is split between almost evenly between FX swaps and spot. And this is a complement to the spot part of the market that has grown 45% from a year ago. So we're talking about an increase, of magnitude of, overall in the UK out of, 7 to 800 billion yards more than a year ago in overall FX activity. And in terms of Japan, we also see a pretty even situation in terms of spot and swap activity. And we now see that it's 348 billion traded daily. It's much closer to considerable gap, 69 billion that it had relative to Singapore a year ago. So, and then obviously we see Australia also have a fairly decent showing, although not quite as robust growth coming out of Australia as we are seeing out of Japan on the spot FX side. And overall FX swap activity appears to be subdued, in single positive, single digit growth rates, a couple of 12% year-on-year growth rates, but nothing really super robust. Of course, these numbers are large as it is, and as you can see also in the ratio of swap versus spot. I mean, Singapore certainly has much larger swap activity than spot, and Japan, about the same, and then Australia certainly does 2.5 times the size of the spot market. So in terms of how the spot FX marketplace operates, what we've seen traditionally has been a spoken wheels, have and unspoke model where the banks interact with corporations, with their buy-side clients, hedge funds, and so forth, and they feed a lot of the activity back to a central point, which has traditionally been the interbank market, where the likes of EBS and Reuters operate, and that has traditionally been the marketplace. And what we've seen over the last few years is that we seem to be evolving more towards a multi-hub, interconnected spokes kind of model, where we're seeing much more activity around the multi-dealer platforms that have emerged. So the FXAll, CurrentX, Bloomberg, FX Connect. I mean, these firms, many of them have been around for a number of years, even a decade or so. And nonetheless, they've come to prominence just over the last 5 to 7 years. And as a result, we're also seeing over the same period, the last decade, retail FX brokers establishing also a significant presence, providing liquidity to, providing aggregating liquidity and being served by banks. And banks have really diversified in how they participate in the market. We're seeing, again, more activity happen away from the main interbank venues. And we're seeing the emergence of a middle market of sorts. So the firms that have traditionally been neglected, ignored by the interbank market, that even though they trade frequently, they are relatively small assets, 15 million US dollars or less. And these CTA firms and high net worth individuals have really big, there's a large number of them, and they're being served by the multi-dealer platforms as well as the retail FX brokers that are setting up unique units to serve this kind of market, and that's what we're seeing these changing times. So overall, one thing that is important to keep in mind is that this market is diverse enough that the needs of asset managers and corporates is different than that of high-frequency firms and retail brokers and even regional banks. So there are key variables like sensitivity to execution costs that do tend to favor the ECNs as well as the multi-trading facilities. When need for large size is a consideration, then the RFQ model-based multi-dealer platforms tend to be of great influence. As a firm needs greater automation, then again interbank matching and it's an important function, no last look. And then this need for support in processing again. This is all of these different models are being supported in the FX market today, and the SDP considerations are being addressed by just about all the venues that we cover. So we have again 3 current market structure that are supported in FX markets: the RFQ, request for quotes, request for streams, type of venues and what they do, as well as the order book, central order book with last look, traditional, and then increasingly we're seeing order book with no last look. That firms like LMAX Exchange, Walton Markets, and ParFX have joined the likes of EBS and Reuters, at least in the concepts of offering transparency and no last look. And in the case of LMAX Exchange, it's more of a exchange model within an OTC, a regulated exchange within an OTC setting that differs from, say, a CME that is a regulated exchange, but in the future side of the market. So there's a lot of innovation taking place in the marketplace. There is a greater emphasis on transparency, and this is where again some of these factors may lead to additional changes going forward. And again, RFQ is where most of the trading activity takes place today, and these smaller circles is where again they're taking place today. But going over time, we might see a shift more towards an exchange style trading, away from the, not necessarily away from the RFQ, because we still think it's going to be huge, but maybe not as dominant as it is today. That is something that again it's something that has to yet be played out, but it certainly makes sense for these kind of changes to continue. So in terms of the firms that are garnering the most of these activity levels, we are seeing the traditional players, the EBS, CurrentX, FX Connect. So CurrentX and FX Connect obviously are part of State Street Bank and one of the major players in FX, along with EBS and Reuters. But over time, we've seen the CME come up and stay at very high levels, and we've seen also Bloomberg come up and challenge the status quo, particularly firms like FX Connect that have sort of the real money kind of players. And we're also seeing other mid-sized players like 360T, Integral, and so forth, achieve 50 to 100 yards a day, and then again, so very few are in the 100 yard a day club, but that club is growing, and this lower thresholds, 15 yards, 15 billion a day to 50 yards a day, that number is certainly getting a little more crowded. And the base of this pyramid, if you will, it continues to get wider and wider. So here there's too many firms to mention, but in the 1 to 5 yard per day group, and these are just a few of the new venues that are popping up and that are serving FX market and the middle market as well. One thing to notice is GMO Click Securities and DMM.com Securities, two very large Japanese players, are now larger in size than a hotspot FX, a traditional player. So these two retail FX players have seen this year volumes again that in the past were not thought of a retail kind of venue, and certainly that is something impressive to keep in mind. Over time, these prime broker relationships, the retail aggregators and high-frequency firms, are affecting a change in the average trade size that we're seeing in the industry. So from 5.2 million overall FX activity now, we're talking about 2 million average ticket size, and this obviously has to do with in the spot market, the average trade size are even smaller, whether it's in London or UK, London or the US. We're seeing again this trend, and basically portends overall changes in terms of what is traded. We're seeing again the prime broker relationships having 30 to 40% of the volumes being traded. We're seeing that certain pairs, traditional pairs like the sterling dollar, not really growing too much, or up until October 2012, dollar yen was not growing too much. Now we probably see that changing as of the April survey. But overall, we're seeing a tremendous amount of activity taking place in Asia in this first quarter. This is just retail FX activity. We've seen a tremendous jump from the 80s, 70 to 80 billion per day, to 170 billion per day. And again, certainly stay above the 150 yards per day, with most of that activity being captured in euro yen and in dollar yen. And much of this volume, I should say, is internalized at the retail aggregator level, and doesn't necessarily make its way to the interbank market. So about half of that it's seen by the street. And just in closing, we are saying that at least this from a retail FX perspective, which I cover quite a bit, we are seeing that this growth is not just East Asia, but it's certainly growing throughout the region, the Asia-Pacific region, and is considerable. And the demographics changes taking place, the wealth being transferred and captured, increasingly the global wealth taking place, being captured in Asia over the next 10 to 15 years, as well as online adoption of the internet and internet practices, and demographics, so the changes in population and the age of population. All those factors favor Asia Pacific, and that's something that I'm excited that we will be able to share with you with the panel. As we now switch over to the panel discussion, I'll turn now the time over to Barry again.
Thanks, Javier. Thanks, Aite, for that deep report. Very eye-opening. The one thing I want to share with you is we're going to end up sharing that presentation to all the attendees, so you will be getting that email from Javier and Aite. So no need to request it. It's going to come at you. The other housekeeping item, we want to go ahead and make sure you guys queue up audience questions, so at the end we can go ahead and have the audience answer, the panelists answer the questions that are coming from the audience. So again, my name is Barry Smith. I'm the Director of Global Exchanges and Trading Venues at Equinix, and we're going to start off with a polling question. So please go ahead and take 2 minutes to answer this first question, and we will go ahead and share some results and then kick off with the panelists. So in what city would you co-locate your trading servers and or matching engine for the APAC region? Select one of the following, either Hong Kong, Shanghai, Singapore, Sydney, or Tokyo. Okay, hopefully we're queuing up. All right, let me count this down 30 seconds. 15. Okay, let's close the poll. Okay, so it looks like, wow, Singapore is the highest. Tokyo and Hong Kong come in tied for second. So let me open that question up to the panelists. Why don't we start with you, Jonathan? What do you think of those answers on the polling? Is it surprising? Do you think it's consistent with what you're seeing out there?
I think it's quite surprising, considering a later question possibly. But I mean, I would certainly say for me, Tokyo is the #1 choice. It's where everybody is. It's where most of the major banks have put their trading infrastructure. It's where the HFTs are. It's where EBS is. So certainly from our perspective, Tokyo's a key point. Singapore is quite important from the aggregation of the banks that are here, and we run into a lot of rules in Singapore, Malaysia, Indonesia, and various other places where you have to keep your customer data in country. So that may be one reason for this. Hong Kong is very surprising because if you actually look at the network connectivity out of Hong Kong, you've got to go through Tokyo or Singapore in order to get to the States. So I really wouldn't bother putting everything in Hong Kong because you're just another hop further away from where you probably need to be.
Nakajima-san?
Yes.
Any comments on the poll?
Yeah, I had the same impression because in FXCM just finished the kind of market research to decide on which location we will set the data center, and our conclusion was Tokyo. We had 4 criteria to evaluate each market. One is the enough number of customers and the market size. And number 2 is the IT infrastructure, data center facilities, and the IT vendors, IT engineers. And the third point is financial infrastructure, including liquidity providers, aggregators, and the settlement and the primary brokerage service have to be, sufficient. And at the same time, function to support retail investors are very important. Quick deposit and withdrawal, retail wire transfers, and the especially that should have the big cover market with the currency swaps and derivative forward. Last one is a government support policy, including tax incentive plan. I think as for the FX market, for the market size and the financial infrastructure, Tokyo market would take the lead. And I personally think that Singapore will come second. And Hong Kong, because of their specialization for the renminbi trade, and could be the third. That is my impression.
Interesting. Okay, well, thanks for the input. Let's move on to the first direct panel questions. Okay, so what are the basic regulatory considerations that non-Asian or Pan-Asian FX market participants must address when doing FX business in the APAC region? Let's start off again with Jonathan. Your comments on the regulatory considerations?
Sure. I mean, first thing to be clear here is that obviously the biggest thing that's going to impact the FX market on a global basis this year and next year is going to be Dodd-Frank. The CFTC has put in rules to make the trading of NDFs and options more transparent. And we're in the business or in the process of implementing a lot of changes for those. Now, for anybody on the call that's interested in the retail part of this, it really doesn't matter to you. This is really, it does if you're an American and are sitting in America probably, or if you're an American institution or a corporation outside of America, you may still get caught by these regulations, so you certainly need to know whether or not you are, because if you are caught, you need to front up and say I'm caught, and then you need to join what is called a swaps execution facility, and you probably need to do that by October. There are currently 4 registered. So there's a Thomson Reuters CEF, which is the one that the FXAll is providing. There's Bloomberg, and there's TradeWeb for fixed income, and in fact market access for fixed income. So currently only 2 registering, because the registration has only been open for the last week or so. So it's a pretty small club at the moment. We'll wait and see who comes across that. But the regulations here are going to have an interesting effect on the Asian market, because this is where a lot of the NDF trading gets done. Singapore has a massive market share in it. It's all done on the phone at the moment. And we'll have to wait and see whether or not all the liquidity is provided by American institutions, or enough of it is provided by American institutions, which then has to go on to a swaps execution facility, which is in a sense a central limit order book and an exchange on the interbank side, and whether or not liquidity in NDFs dries up and we end up with fully convertible currencies very, very quickly. That may be a bigger shift than everybody's anticipating. But at the end of the day, we're going to see all these trades reported. Eventually, they'll have to be cleared. But also even just the reporting regime around the Dodd-Frank piece means that every swap and every forward transaction done by an American person needs to be reported wherever you are in the world. So there's an awful lot of infrastructure that's getting put in place. There are clearing houses which are getting lined up ready to clear these products. We have to build options order books, which is, again, fairly new for most of the FX market, because everything's been done on a RFQ basis or over the phone. So there are some big changes coming in 2013, 2014.
Interesting. Nakajima-san, what's your view from Tokyo as far as the actual regulation?
Okay. I think many brokers from Japan also wants to do the business in Asian countries. But I think unlike EU, Asian countries have their own regulations, and so we, in the first place, have to obtain the local business license, and it would require the local internal control rules, and in some cases, to establish the local entities, and we required the local equity participation. And we also have to be careful to meet the different regulation and to run operation, such as minimum margin ratio, non-resident participation, and regulatory reports, etc. And I think like a Dodd-Frank issue will be influenced and will have a certain influence for the liquidity provision issue, but maybe I think a local regulatory requirement will be the larger issue for the person who wanted to start the business in Asian countries. Also, it becomes more important to have the data center there to set the liquidity provision function. I think that recently we have more volatility and the more strong participation from high-frequency traders, then the latency becomes a more important issue. So to trim the latency to avoid the rejection ratio, I think people have to have those liquidity provision function in Asia.
Interesting. Okay, let's move on to the next question. This one is fairly pointed, so let's just get on with it. It says, what are the major users of FX liquidity? Corporates, asset managers, retail FX aggregators within the Asian Pacific region, or does the type of major participant vary by country? So obviously this is a question more or less probably country by country that also has to do with regulation as well. Nakajima-san, you want to go ahead and comment on the actual mix of people utilizing FX trade?
Okay. I think as you mentioned, that it depends by country. Among Asian countries, still U.S. dollar is a dominant invoice currency. And in order to convert or hedge currency risk, trading companies use an FX liquidity. Even in Japan, around 54% of invoice is US dollar denominated, and Japanese yen is just 29%. So that is a kind of major force in Asia. Then, if the market becomes more mature, then the currency swap market becomes larger, and then asset managers will use those markets. And I think aggregators and FX aggregators can be run their business where margin FX or retail FX trades are officially permitted.
Okay, interesting. Jonathan, your view?
Yeah, we have a very broad base of clients, so we're fairly well exposed to all these different areas. I mean, obviously with GMO and DMM doing in excess of $1 trillion each, I mean, it's obviously the largest bit of FX that gets done, because that's bigger than some of the guys that are in the top 10 in banks. So that's a large amount of FX that's getting done. So the technology employed to do that is quite amazing. But most of that, and all of that, is in Japan. I mean, Asia's catching up. Australia's not happening that much. Asset managers, again, are focused, are based mainly in Japan and Australia. The Australians have a bigger international appetite, so they probably do a lot more. And this is where Javier's presentation said that the Australians do a whole bunch of swaps. Well, most of that comes out of their pension fund business, which is investing overseas. So that's really big. The corporates, and we still have some asset managers in Hong Kong and Singapore, and the hedge funds are split equally between those two things. So some guys in Australia are running some hedge funds, but of course co-locating everything currently either in London or New York with regard to technology. And corporate FX in Asia across the board is nascent by comparison to Europe and America, where it's been going for many years, since we kicked off in sort of 2000. And quite often you'll actually find that a corporate treasury in Asia will decide to use EFX. It's generally when somebody from Europe or America has emigrated or is on a posting to that particular country with a new firm or their firm, and walks in and goes, "Where's your EFX?" And they go, "Well, we don't do it. We do it on the phone." And that's when that change actually happens. So I think we'll see a massive growth in corporate FX over the next probably 7 years as people become more efficient and these guys get bigger and realize that there's a whole bunch of efficiencies they can get by running their disparate and multi-country environments through a central treasury, or getting hold of that workflow and making sure that actually works for them and they're not double dipping in various pools.
Okay, thanks. That's good insight. And the next question. Asian FX markets are quite diverse by FX products, spot, forwards, and swap varieties, and do not necessarily resemble what we see in the West. That being stated, according to the Bank for International Settlements, the BIS, in 2010, the outright forwards and FX swaps market turnover was over 2 times the spot market. Do these stats still hold in 2013. Why don't we go to Javier on this one? I know, Javier, you had some stats within your presentation. You want to discuss kind of if you think these still hold the BIS. I know that every 3 years they update, so they should be out probably in the fall pretty shortly.
Right. So we're going to get the preliminary release of the BIS 2013, April 2013 survey sometime either late August or in September, and then the final results in December of this year, hopefully, if not January. And what we're likely to see is that the market overall has risen for anywhere from 4.5 trillion to 5, maybe a little bit more even. It's quite possible. The bulk, about 2 trillion worth of the daily turnover is going to continue to be FX swap, and what we anticipate at Aite is that the spot part of the market is going to grow considerably faster than the FX swap, which has been mirrored in the new regulatory effort. And as a result, not growing as fast, but even if it grows at 5%, I mean, it has a huge base, and that's, that is considerable, 100, 200 billion more. But in terms of the outright forwards, not nearly as big as the spot FX, but yeah, when you combine it with the FX swaps activity, obviously, you could see that sort of ratio still hold, perhaps more so in Asia than in the rest of the world. In the U.S., for example, you don't see that sort of ratio. In the UK, as I mentioned, it's pretty even. So, so yes, I mean, I do think that there's, NDFs and FX options, those other type of FX markets are gonna continue to grow pretty fast over the next few years as well.
Interesting. Okay, Nakajima-san, you want to quickly give your view on that spot market?
Yeah, I think I have the same view. Even in Japan, the growth rate of the currency swap is the largest. And I think that is the same situation with the Singapore and Hong Kong. So there, with the regulation trade and the mature trends of the market, I think that currency swap ratio will keep rising. And I think that the Asian market will continue to have the same structure, even in to the 2013.
Okay. Okay, we're going to move on now to another polling question. So what major APAC city has the most restrictive regulation for trading FX? And you're going to get 15 seconds to go ahead and answer this, so be quick with the mouse. 5, 4, 3, 2, 1. Okay, let's see what those results come back. Okay, so it looks like, wow, Seoul is the biggest. Hong Kong is second biggest, which is interesting. I guess everybody who responded they would move to Hong Kong probably going to run into some issues setting up their infrastructure. Singapore, okay. Interesting. Let's do this now. Let's move on to, we have one question that came already from the audience. So why don't we go ahead, and if everyone wants to continue to key up some questions, that would be great. So here is the question. For a new entrant in the, whoops, 1 second, sorry. For a new entrant in the middle market section mentioned by Javier, is it quite expensive to set up a trading operation from technology and broker connectivity view? Are we seeing more and more entrants in this space? If yes, why? Jonathan, you want to go ahead and take the lead on that one?
Sure, we're seeing a lot of guys set this up. I mean, obviously the banks have been going through a whole bunch of restructuring, been losing people off the desks. Those guys have got trading capabilities. A lot of them understand the e-business as well, or they've partnered up with people who understand the e-trading part. So there are lots of shops that are setting up. Yes, it's expensive if you want to do it properly. If you don't spend the money, like most things, you get what you pay for, and you get run over a lot because your systems aren't fast enough or they're not close enough to the exchanges on the ECMs that you want to trade in. But a lot of these guys also start hedge funds. They know how to trade. They don't need to trade as a high-frequency guy. They can trade more different algorithms, different strategies. They set themselves up as macro funds, combining their skills with some guys that have some different views and look at different asset classes. So purely in the FX world, if you want to do this properly, you're up against some of the biggest names in the market who've been investing millions/billions of dollars in doing this in options, then equities, and now FX. So yeah, don't think that you can buy a couple of fast servers and plug them into the internet and you're going to get a result, because you'll lose an awful lot of money.
Okay, Nakajima-san, your view on the cost to set that up?
Okay, for Nepal, this result, and I completely agree. And as on the whole, many people think that in order to protect the domestic market, and there were many regulations. And as for Singapore, still that for the cross-border trades in the currency floating systems, and has a limitation. And as on Hong Kong, still it's a very charming market, because there may be transactions, but still there is a regulation for the transfer money. So I think this result seems to me very reasonable.
Okay, interesting. Let's move on to the next panel question, please. Is the curve of cross-connect growth within major Asian data centers developing much in the same way as New York City and London data centers were a few years back? What is the growth in cross-connects telling us? I'm going to take the lead on this one, being from Equinix. And one thing I can say is we certainly have seen a major shift from the New York region and London moving initially to Tokyo as the first hub. I had gone back and had some of my coworkers look at some data, and one fact, in the past year we have seen cross-connect growth rates in Tokyo exceeding 1,000%. So you can clearly see that there's almost a follow the sun type of trading going on throughout the world, and the question for Asia then is, are we going to see some more intermarket connections as well between Singapore, based on the results of the one polling question, Hong Kong, and also Tokyo and possibly Australia. So potential to go ahead and see more of a Metro Connect. Javier, what do you see in that space? You see the same sort of progression?
I do, and just for the non-initiated, in the cross connects, by that we mean the ability for a firm to reduce latency, trade latency, by placing their trade servers within a cable, a certain length of cable distance, to minimize, again, latency that can be involved when you remove yourself, say, from a different building or a different server farmhouse. So a cross-connect means basically you're in close proximity, relatively speaking, where you can just run a cable to another trade server that generates a lot of activity. So cross-connect, in essence, is a way to, what we're seeing, clusters of participants cross-connect to each other. And then again, I think it's remarkable that the growth we saw in Chicago and then repeating in London and New York in terms of the number of cross connections, and latency is an important consideration. It's not necessarily the only consideration, but lately firms have been looking to reduce costs instead of doing point-to-point connections, more of co-locating their trade servers to in close proximity to that of other major participants, the major banks, the major exchanges, and again, and those are factors that I think are going to continue to impact the market in Tokyo, Singapore to some extent as well.
Okay. Jonathan, your view from FXAll, are you seeing a lot more cross-connects in Asia?
Yeah, we're seeing a lot of people getting connected to a lot of other people. One of the interesting challenges around this is the liquidity mirage, the fact that we're probably down to about 10 or 11 or 12 possibly real market-making banks, plus we've got a bunch of HFTs, but it depends what sort of liquidity you want to consume. And if you're not connected to those top 12 and you're connected to a bunch of others, then you could end up just recycling the liquidity that's from the top 12. So the cross connects, you've got to be a bit careful as to where you're actually playing, where you're placing your bets, where your flow is going. And so it's very important to construct a very strong panel of guys that you have a relationship with, that understand how you trade, and then combine that with a sort of anonymous ECN environment that also allows you to execute passive as well as active strategies, maybe in a more aggressive manner on the active side, so that you get a good balance of execution capabilities.
Okay. Let's move on to the next question. What is the outlook for FX growth in Asia Pacific, retail and institutional, in light of the regional economic policy changes? Javier, you want to take the lead in?
Sure, I'm happy to. So I think what is come to be known as Abenomics has been tremendously important for dollar yen, euro yen trading activity. This, well, from late last year to today, I think that still has run to go, and part of that has to do with expectations of what does the market think is the yen volatility or the yen weakness, if you will, has it reached an end? Because certainly it's changing the comparative position of Japan in Asia, and that's unnerving Asian partners that so far were pegged to the dollar more or less, and enjoying a comfortable lead against against the yen that kept it strengthening against the U.S. dollar. So now with this reversal, going from 70 some yen to the dollar to 100, 105 yen to dollars, and obviously that's a major comparative shift that is impacting Asia also at the same time as China is decreasing its economic vitality and slowing down in general, and hopefully turning more to internal consumption. So all of these changes at the macro level are impacting perceptions of where currency rates are heading, as well as so it's great for volatility and for market activity and being part of the market in Asia, certainly to understand again how these expectations are changing.
Great. Nakajima-san, being at the center of the yen devalue over in Tokyo, what's your view? Could this just shift away if somebody else ends up devaluing? Could you see this staying in the home countries, or what's your view of the overall changes there?
Yeah. I think that we have to divide the discussion in a short term and the long term. And as one Abenomics and looks successful so far, and it has changed the expectation of deflation. So there are many people start thinking that consumer price will go up to some extent, and the one of the main cause of the strong yen was a deflationary impact on the exchange rate. So I think that is the change of the course. At the same time, in Japan, we continue to have trade deficit, and many people start investing in foreign currency denominated assets. So I think this trend will last. One thing that we have to keep eye on is a trend of the consumption, consumer consumption. Currently, the unemployment ratio was improved in the investment on the housing sector is hit the bottom, but still we are planning to implement plan to raise the consumption tax. So if it has the negative impact on the consumer consumption, then might have some impact. And the another impact is from the Chinese economy slowdown. And in Japan, many people prefer to invest in currency pair OGN, but then because of that, and OGN becomes weakened a bit. And since OGN has a higher swap point, and its interest rate is around 2 to 3% on the yearly basis, but then it increase the volatility of the market. But I think that when we see the long-term structural changes in Asia, I think more people will use the local currency for the like a trades or some other transactions, and to avoid the currency risk. So I think at the same time, after the Chiang Mai Accord, and the central banks have tried to support the liquidity, liquidity situation, and at the same time, bilateral convergence system will be implemented. So I think we'll have a kind of shift from the U.S. dollar denominated transaction to local currency transactions. It will help DD to grow the Asian market as well. And at the FXCM, and around 40 to 50% of profit has already comes from Asian trades, and I think that ratio will go up.
Interesting. Okay, thank you. Let's move on to a question from the audience. I'm going to direct this at Jonathan. So the question is, only U.S. persons are required to trade on a CEF. Asia is not the U.S. Won't liquidity just stay on non-CEF Asian platforms?
Yeah, it's an interesting dilemma. We won't actually find out the answer to that until probably March or April next year at the earliest, and it will probably take a while for us to reach the end goal or the end result of that thing. So if you're an asset manager and you have American money in your fund, you're caught. Now, if you are let's say a $500 billion fund, as some of these pension funds in Australia are you going to segregate out your American assets, or are you going to lump them all together? Do you then have to trade everything on a CEF? So that's one area where people will get caught. If you're an American corporate, you're probably going to get away with it, but a bunch of these guys run risk stuff within their operations, which isn't purely hedging a specific transaction, in which case that'll get caught. So there's regional banks that will get caught, and there will also be a lot of people that will think that if all the flow is really with the American banks anyway, and they're going to end up consolidating this into a new platform, they need to be part of it. And when we've seen in the last 20 years ECNs popping up, as we first called them in the equities market in New York, and then we did MTFs in Europe, these new places attract liquidity because they're generally efficient, hopefully cheaper, although the clearing part of the CFTC regulations may actually make these things more expensive to trade. But if you reduce the spread that you pay and you get a better execution, you'll see more flow come to these things, and people in Asia may well want to participate in it because it's there and it's a cheaper transaction at the end of the day.
Right. So we'll probably end up looking at a total cost of trade model and understanding margining and everything else much more closely, I think, throughout the globe on the CEF side. I'll close this off with a polling question. So the last polling question is, what are the Asian cities fighting for regional supremacy in FX trading? So 15 seconds. Five, 4, 3, 2, 1. Okay, so why don't we throw this up very quickly for an answer from, let's lead with Nakajima-san. Is this surprising, not surprising? Is it realistic?
I think that for me, it's a bit surprising. But Singapore put this kind of to strengthen the market activities and as a kind of government policy. And they do a lot of support for data center issues and also prepare a lot of tax incentive plans. So I think that those things was appreciated. And I think I hope Abe-san's cabinet could do something to reactivate or vitalize the Tokyo market again, and they will implement some countermeasures.
Well, as we know, regulation drives a lot of this. Jonathan, you want to go ahead and very quickly?
Sure, very quickly. I mean, Tokyo runs retail. All those retail guys who run those things are going to branch out into the rest of Asia. So I think we'll see the rest of Asia growing. The number on here that really surprised me is 0% for Hong Kong because of the result we got on the other poll, where it was 30% for where would you put your trading infrastructure. Because Hong Kong has loads of regional banks. There's a lot of flow in there, but Singapore is certainly winning the battle at the moment.
Right. And Javier, last say?
Sure, it is a bit surprising, too heavily inclined, I guess, in our audience, perhaps in terms of the swap activity taking place out of Singapore, and not so much spot effects, which clearly Tokyo is the leader in. I'm also surprised, like Jonathan, with Hong Kong and not being on the board.
Okay. Well, I want to thank all the panelists. I think everything was hopefully insightful for the audience. Thank the audience for their time. And hopefully we'll see you again. Expect the Aite report coming out at you. And again, thank you all, especially the panelists.